Yeah. Good afternoon, everyone. It gives me great pleasure to welcome you all to another insightful session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We deeply value your continued participation and enthusiasm for professional learning. Today's session focuses on the area that lies at the very heart of financial reporting and measurement, understanding borrowing cost, concepts, recognition, and measurement. This 19th webinar in our series reaffirms our commitment to strengthening professional competence and deepening understanding of key accounting principles. In today's session, we will delve into the conceptual framework and practical aspects of accounting for borrowing cost under the applicable accounting standards. The discussion will highlight how entities identify qualifying assets, determine which borrowing cost can be capitalized, and apply the relevant recognition and disclosure requirements. We will also address interpretational challenges and common practical issues faced in implementation. Our discussion will cover key areas such as meaning and scope of borrowing cost, criteria for capitalization and cessation, accounting treatment for specific and general borrowings, presentation and disclosure requirements. To make this session more engaging, we also have incorporated live poll questions. We encourage you to actively participate by clicking on the open poll button when prompted by our distinguished speaker. Your responses will make the discussion more interactive and enriching for everyone. We look forward to an insightful and thought provoking session. Thank you once again for joining us. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, C. Achal Jain sir. Before we move forward, it's my pleasure to introduce the moderator for today's webinar, CA Paras Chadda sir. CA Paras Chadda is a qualified chartered accountant with over 13 years of professional experience in the field of financial reporting and advisory services. Specializes in gap conversions, IGAP to Ind AS, IFRS, US GAAP, review of financial statements under multiple frameworks, and evaluation of complex accounting areas such as business combinations, consolidation, financial instruments, share based payments, revenue recognition, and leases. He also holds ICI certification in Ind AS and BRSR and serves as a registered technical reviewer on the panels of FRRB and Research Committee of ICI. CA Paras Chadda is a regular faculty of ICI's INDES certification course as an active member for ICI branches and corporates on accounting and auditing topics. Over to you, sir.
Thank you so much, Rahul, for that kind introduction. Good afternoon, everyone, and a very warm welcome to all of you. First and foremost, I would like to thank Chairman of Accounting Standard Board, CA Dr. Sanjeev Singhal sir, and Vice Chairman of Accounting Standard Board, CA Vishal Doshi sir, for organizing this session and giving us this opportunity. I have the pleasure of serving as the moderator for today's session on borrowing cost. So as Rahul mentioned, today we will be exploring the concepts, recognition, and measurement of borrowing cost. We are honored to have with us Achal Jain, who is an eminent speaker and brings a wealth of knowledge and experience to this topic. Achal is a chartered accountant and has qualified his BCom honors from University of Delhi. He is currently into practice with more than 17 years of post-qualification experience in assurance and advisory services. Prior to this, he has worked with assurance and advisory practices of Big Four firms. He has considerable experience in providing trainings to the clients on SA, Ind AS, IFRS, and US GAAP. He is an active speaker with the ICI, NAFRA, and IICA for training programs on audit and accounting. He has significant experience in assisting clients across industry sectors, be it manufacturing, real estate, power, construction, service, software, media, and training. So before we begin, just a quick note on the format. Achal will be speaking approximately for 1 hour 30 minutes on this topic and followed by a question answer round. Hence, I encourage everyone to jot down your questions so that we can discuss them towards the end of the session. Over to you, Achal.
Thanks so much, Paras, and thanks, Rahul. I would also like to thank ASB, Sanjeev Singhal for this opportunity once again to share this discussion and to have this discussion amongst ourselves in terms of this particular topic. So as regards this topic for today, I would say this topic is not very technical in terms of the accounting requirements, but at the same time, you find this topic to be very relevant. Yeah, because generally, if you look at the organizations, you'll have this requirement of accounting of the borrowing cost. And this borrowing cost is not really limited to the interest. In fact, this standard goes beyond interest. And there's a perspective around the interest, the way this interest is required to be picked up. That is what the standard tries to capture. Okay, so what I'll do is I'll just now share one presentation with the help of which we'll just, sort of have this discussion in respect of borrowing cost. And during the course of our discussion, if you have any questions, any doubts, you can just send across your queries so that maybe after we are through with this particular discussion, we can have this interaction as regards those queries also. Okay, so now moving on to Ind AS 23 borrowing cost. Now, what is a borrowing cost? Let's try to understand about it. Generally, when this discussion around the borrowing cost is done, so we think of borrowing cost as interest, okay, which is true. There's no doubt that interest is nothing but a borrowing cost. But as regards this standard, borrowing cost is not limited to interest. So you can say interest is an example of the borrowing cost, which is included in the in the borrowing cost, or you can say which is covered in the purview of this particular accounting standard. So now let's talk about borrowing cost. Now, what is this borrowing cost? Borrowing cost can be interest or any other cost which is incurred in connection with borrowing of funds. Now, this is an important point to understand. So any cost which is incurred in connection with borrowing of funds, that is what you call as borrowing cost. So for example, generally when we go borrow funds, so interest is something you'll always have. But along with interest, a very common cost that we pay happens to be the processing fee. Okay, which is also called as upfront fee, processing fee. Yeah. So now, what is that processing fee? That processing fee is also a borrowing cost. In fact, the way this standard requires the borrowing cost to be looked at is not by looking at it as if it's the interest which is there as per the contract, okay, which we can call as, say, contractual rate of interest. But this standard requires the entity to consider what is the effective cost to the company in terms of this borrowing. And that is where we have this principle of effective interest rate as well. Yeah. Now, we'll talk about this effective interest rate in further details. Now, what are the other things that we may have within the purview of the standard? If let's suppose we talk about lease liabilities. So in respect of recording of a lease liability, there again we see this interest component coming up. So you record this as per the requirements of Ind AS 116. Okay, so there is a separate standard which deals with that. But in respect of that lease liability on which this interest cost is captured, so that interest is nothing but a borrowing cost. Okay, yeah, so that is another component of the borrowing cost. So you can say that is also an example of the borrowing cost which you will cover. When you look at the financial instruments, in fact, this is again a detailed discussion I'm sure we have had, and of course these are something which keeps continuing as around the financial instruments. Now under Ind AS, we do not really go by the legal form of the instrument always. So the standard requires one to go beyond the legal form. One should always look at the substance of the arrangement. Okay, that is what we also call as substance over form. So therein, what do you understand? That if there is a particular instrument, you need to assess whether that instrument is in the nature of a debt to the entity or is in the nature of equity to the entity. Yeah. So if let's suppose that happens to be a debt, then any return which the entity will pay on that, what do you call it as? That is again a cost on that debt. So that's why we can take an example of preference shares. Okay, if let's suppose there's a preference capital. In the legal form, you call it as capital. But if let's suppose that instrument is it is the one which is in the nature of preference shares, which has been treated as debt. Why? Because that meets the criteria of debt as per the requirements of financial instruments. In such a case, the preference dividend that we pay on that. So that is what? That is again a cost of that debt, or you can say cost of that instrument. Yeah. So what will you call that cost as? That is again nothing but a borrowing cost. Okay. So that is again, you can say an example of the borrowing cost. Yeah, which is required to be captured over here. Then, as we move further, we will also have a discussion as around the exchange differences. Now, generally, what is this exchange difference? If let's suppose you have a liability or you have an asset which is denominated in foreign currency and which is monetary in nature, so what do? You restate that at every reporting date. And any difference which arises due to this restatement. Why? Because the foreign exchange rate may change. So any difference which arises. So what do you call it as? That's a foreign exchange gain or loss. Now, this standard talks about such foreign exchange differences as well in respect of foreign currency borrowings. That in some of the cases, even that exchange difference, that forex loss, may also be treated as an interest. So we'll talk about it separately. Okay. So this is, again, you can say, could be an example of borrowing cost, which is getting covered under this standard. Yeah. And of course, the one that we are going to discuss quite significantly is about the interest on the borrowings. If let's suppose an entity has taken a loan from the bank, and let's suppose the contractual rate happens to be 9%. Yeah. In this case, one is the cost which is in the form of rate of interest, or you can say which is in the form of interest, which is there as per the contract. So that is generally what is considered as the borrowing cost. But other than that, there is also a processing fee. Let's suppose there is a processing fee of 1%, which is paid on a one-time basis. So that is also a cost of borrowing. Yeah. So what does the standard require? Standard says that one should look at the effective cost of the borrowing. So therefore, in this case, even though the contractual interest rate is what, 9%, what is going to be the effective rate of interest for the company? Will that be 9%? Answer is no, it will be more than that. Yeah, it will always be more than that. Yeah, so we need to look at the effective rate of interest whenever we'll have this discussion as around this borrowing cost, and not really the contractual rate of interest. Okay. Now, whenever we talk about any borrowing cost, so what is the accounting treatment of that? So we can just, for the time being, say that if let's suppose there is any borrowing cost, so what do? You will take it to P&L. Okay, so let's try to keep it for the time being. If let's suppose there's a borrowing cost, you will take it to the P&L. Okay. Now, there are certain situations which the standard specifies wherein we need to assess as to why is that cost incurred, or you can say where is that fund utilized by the company. If let's suppose the fund means the loan which the entity has availed is utilized, say, on an asset which is in the nature of a qualifying asset. So now we are talking about a qualifying asset. In such a case, this accounting treatment of taking the interest to the P&L will not apply. So what do? In such a case, interest will be loaded on that qualifying asset. So you can say it will be capitalized then. It will not be taken to P&L. So we can say this is one sort of exception, yeah, which arises in respect of accounting treatment of borrowing cost. Okay. So now let's try to understand as to what is a qualifying asset. Why? Because it's an important point for us. Why? Because it requires an assessment on the part of the entity. Why? Because eventually the accounting treatment is going to change. So what is a qualifying asset? Qualifying asset, we can say, is an asset that necessarily takes substantial period of time to get completed. Means to get ready for its intended use or sale. Now, what could be an example for this? We can say road, dams, bridges, building. All of these are examples of what? They are nothing but the examples of qualifying assets. Okay, yeah. So whenever there is a company having a borrowing, so we can say there are two steps which the company will have to look at always. What is going to be the first step? Whether there is a qualifying asset or not on which that particular loan is getting utilized. If yes, then you will note it on the qualifying asset. If no, then of course it has to go to the P&L. Okay, so we'll continue with the same accounting adjustment of taking it to the P&L. You'll charge it to the P&L straight away. Okay, now the next question arises that as regards this capitalization of the borrowing cost. So now whenever we'll talk about borrowing cost, so we may interchangeably use this term interest. So by interest, you should not be thinking that it's only the interest. By interest will mean that borrowing cost. Okay. So now the next question arises that how do we deal with this borrowing cost? Means when do you start capitalizing it? When do you stop doing this? Okay, means when will this come to an end? So when does it cease? Or will there be any period in between during which you may not be capitalizing the borrowing cost on the qualifying asset? Yeah, so now we'll move with the assumption that the qualifying asset is in place. So that's why the borrowing cost is now required to be capitalized. Okay. Now, standard says we need to look at two things. Now, what are those two things? Let me just do one thing. Let me just share one working file. So in the working file, we'll just try to have this discussion. Okay, so now, say for example, during the year, company has taken a loan. Okay, so the company has taken a loan. So the loan amount is 50 crore. Okay. Now, this loan is taken for the purposes of construction of building. Right? So now, when does this construction start? Let's suppose this construction started on 29th October 2023. Okay. Now, in respect of this construction, what will happen? Any interest that you'll have on this loan. Now, because it's a building, it's a qualifying asset. So that's why what will you do? You will add it to the cost of the building. But up to what date? Till the time the building is not ready for use. So let's suppose the construction of the building gets completed on 29th October 2025. Okay. Now, for this entire period, what will you do? Interest will be added to the cost of the building. Okay. Now, let's suppose on 29th October, building is ready for use, but the company has decided that they don't plan to use the building means they will not start using the building on 29th of October. So what do they plan? So they are planning that maybe sometime starting from 15th of December 2025. Okay, so this is the date they have kept when they will start using this building. Okay, so you can say one is the date of ready for use and the other one is put to use. Yeah, so generally there is a confusion as around this ready for use, put to use. Now during this period, so if you look at this period, will the interest cost be incurred by the entity? Answer is yes. Why? Because the loan is not yet repaid. Okay, because if the loan is not yet repaid, so what do? Interest cost will continue. Yeah, and this loan is taken specifically for the building only. Yeah, so now comes the question that should we be adding this cost of interest on the building up to 15th of December? Yeah, that's thought process. Okay, one may have a discussion on this. So up to what date you keep capitalizing this? So do you do this up to the date the building is ready for use, or do you keep doing this till the time the building is not put to use? Yeah, so in this case we will not go by this put to use. Any cost can be capitalized with the cost of the asset only till what date? Till the time it is not ready for use. The moment you say it's ready for use, we'll stop capitalizing the interest on that. Okay. In fact, any other cost cannot be loaded on that asset, including the borrowing cost. Clear? Now, of course, if let's suppose before the asset is ready for use, if let's suppose the loan is repaid, so will there be any interest cost? Answer is no. So of course that will cease from the date the loan is repaid, if that date happens to be prior to the date the asset is ready for use. Correct? Now, there is another point which the standard talks about. Sometimes what may happen is, let's suppose during the construction period, let's suppose there's a layoff, okay, in the sense that this construction has been suspended, let's suppose for some period of time, and which is abnormal in nature. Okay, it's not in the normal course for the company to do this. It's sort of abnormal for the company to do this. Means for some abnormal reasons this has taken place. Now, during this period, if let's suppose there is any stoppage, but that stoppage is in the normal course, so will you keep capitalizing the interest? Answer is yes. But if that is abnormal, so can you continue to capitalize? No. So for that period, you will have to again stop the capitalization and then restart. Or you can say you'll have to not capitalize for this period when there is a stoppage, okay, which happens to be abnormal in nature. Yeah, clear on this? All right, so now what we will do is we'll try to pick a few examples. Okay, basis this, let's try to pick a few examples here. All right, so now let's look at some examples. A telecom company has acquired a 5G license. Management intends to use it to operate a wireless network. Development of the network starts when the license is acquired. Now, in this case, should the borrowing costs on the acquisition of the 5G license be capitalized until the network is ready for its intended use? That's the question. Okay, so what do you think? What should we do? Answer is yes. See, the license has been exclusively acquired to operate the wireless network. Okay. Now, in this case, if you look at the acquisition of the license, what is this? It's the first step. Okay. Acquisition of the license is the first step. It's a part of the investment in the network. Okay. Which actually meets the criteria of a qualifying asset. So therefore, will you include it? Answer is yes. Answer is yes. Clear? Next. Let's look at this example. ABC Limited is constructing office complex having 3 towers. Okay, so there are 3 towers. They are in the process of constructing. Now these towers will be constructed in 3 different phases. So what do we have? So first of all, you'll have tower A, then you'll have tower B, then you'll have tower C. So all in all, if you look at all of these 3 towers, that is nothing but a single complex. Okay, so within a same complex, you'll have 3 towers. Right? Now, first phase involves construction of tower A. So that is what you'll have in first phase. Right? Which is completed by 30th June 2025. So when do you complete it? So this gets completed on 30th June 2025. However, tower B and C, if you look at these 2 towers, their construction is going on. Okay, so that has not come to an end. Now comes the question that how should you capitalize the interest cost? See, there are 2 ways you can look at it. Okay, so then you can just think about the answer. So the first way is what? You will consider this entire project as a single project, irrespective of the towers involved. So you'll say till the time this entire complex is not ready, I'll not consider this complex to be ready for use. Therefore, even if tower A is ready, any interest cost which is incurred in respect of the loan which is utilized for tower A, I'll continue to keep adding that interest on this complex even beyond 30th June. Okay, so that's the first thought. Other thought could be that each of these tasks is an independent asset. Correct? So they are independent to each other. And that's why once this star A is completed, we capitalize it, and therefore we stop further capitalization of any sort of cost on this, including the interest. Yes or no? Yeah. So which one do you think is more appropriate? See, the only one which is appropriate is what? Second one. In this case, capitalization of borrowing cost in respect of TAR A will cease when? On completion of phase 1. What is that date? 30th June 2025. So you'll have to take each of these TARs independently, and that's how you'll have to look at it. Clear? Now, let's look at one more example. Apex issued an unsecured loan on 1st April 2024. So that's the date when the loan has been issued. Loan was specifically issued to finance the building of the new store. Okay, so that's the purpose. Loan was specifically issued to finance the building of the new store. And that new store, okay, so we are talking about building of this new store, meets the definition of a qualifying asset. So once again, what do we have? We have a qualifying asset over here. Clear? Construction of the store commenced on 1st May 2024. So let me just put it down over here. So there is a loan on 1st April 2024. construction started on 1st May 2024. It was completed and ready for use on 28th of Feb 2025. After that, we have this reporting year end, 31st March 2025. Further, we also understand that this store was not opened for trading until 1st April 2025. Okay, even though it was ready, this has not been put to use. You can say that. Now, during the year, so if you look at this financial year, okay, so we have this financial year, April to March 24-25. Trading at Apex other stores was below expectations. Okay. So Apex suspended the construction of the new store. So this construction which was going on, this got suspended. Okay. For a 2 months period. Now, which are those 2 months? Say these are the 2 months. July and August 2024. For these 2 months, no construction was done for the reasons we just discussed. Now, in this case, what do we need to do? We need to calculate the period in which borrowing cost should be capitalized. All right. Yeah. So we need to calculate the period in which borrowing cost should be capitalized. Means for what period you will capitalize the borrowing cost. Clear? Yeah. So you can just start thinking about it. What will you consider? Yeah. So the way you'll want to approach this. So in this case, so when do we start? When the expenditure is incurred. Correct? 1st May 2024. Now comes the question that up to what date you will capitalize. Should it be 28th Feb or 1st April? I think this we have already discussed. Yes or no? We have already talked about it. That we can't capitalize up to the date the asset is put to use if let's suppose the asset is already ready for use. And which is the case over here. So that's why what is going to be our cutoff? 28th Feb. Right? So that is when it comes to an end. So it starts on 1st May, ends on 28th Feb 2025. Clear? But if you look at this period, during this period, we also understand that there was a stoppage. Yeah, when the construction was suspended. And can we say that this construction which got suspended is in the normal course? Answer is no. The reason doesn't appear to be a normal one. So that's why for these 2 months, the interest cost which has been incurred by the entity, can we capitalize that? Answer is no. So for these 2 months, we cannot capitalize. Okay. Yeah. So for this period, again, we can't capitalize. In fact, any period after 28th Feb, you can't capitalize. So that's why what will happen? What will happen? Thus only for 8 months of the year, finance cost can be capitalized. What are those 8 months? 1st May to 28th of Feb, excluding July and August. Right? Right? Now, every time, what will you have? Let's suppose the total interest cost is 100. See, the total interest cost or the total borrowing cost is not difficult to be found out. You can always compute. Easy to compute. Correct? So every time you have this situation, what do you need to look at? You need to look at only one point. From the total, we need to find out the amount that will be capitalized. Okay. So once you have this amount, let's suppose that is 30. So the balance amount, do we need to get into the details of that? No. Why? Because this balance amount will go to P&L straight away. As a matter of fact, what did we discuss? Interest goes to P&L, except in this situation. Yes or no? So that's why for this situation, if you can compute the interest amount, you will capitalize it, and remaining amount you will push that to P&L. Okay, clear on this? Yeah. All right. So now moving further. Now before we, in fact, I think start discussion around the types of borrowings, maybe what we can do is we can also practice some more questions. So I think we have got some MCQs. So what I'll do is I'll just run some MCQs, and this is what you need to attempt. Okay, so you can just always select the option, okay, and try to answer as to which one is the correct one. Okay, so I'll just run this first MCQ. Okay, let me just increase the size. All right, so now let's look at this. XYZ Limited is constructing a dam. Okay, work began on 1st April 2024. Due to government litigation, construction was stopped for 4 months, November 24 to Feb 25. Okay. Borrowings were what? 20 crore at the rate 9% per annum. So that's the interest rate which is available to you. And you will assume this to be the rate you will consider for your accounting purposes. Then the construction got resumed in March and it continued actively. Now, in this case, the question arises, how much borrowing cost can be capitalized for financial year 24-25? Over to you. What do you think? I think it's a very simple one for you to calculate. Over to you. Which option you will select? A, B, C, or D? Quickly, if you can just select the option. So which option you will select? Quickly. Rahul, if you get to know the option which is selected by majority, I think that will be helpful for us to discuss. Yeah, quickly, everyone, you're through. I think through this polling, you can answer. I'm just hoping everyone has answered this. Yeah. All right. So now what I'll do is I'll just discuss the solution. Maybe towards the end, we can also look at which all options you would have selected. Okay. So now in this case, what should be the right answer? Option number D, 1.2 crore. So let's try to understand why. See, the borrowing cost for 12 months will be what? 20 crores into 9%, 1.8 crore. For the 4 months period when this construction got suspended, now will you call it as normal or abnormal? Clearly abnormal. So will you be adding this to the cost of the asset? Means will you be capitalizing this? No. Okay, so these 4 months will have to exclude. So that's why what period will capitalize? 8 months. So that's why what should be the proportion that you capitalize? 1.2 crore. So that's why what is the right answer? D. Okay. Yeah. Clear? Simple one. Great. All right. So let's pick up one more. Okay. So one more will pick up. I think similar sort of question we have already discussed, but we can just pick up. LMN Limited is constructing a hospital in 2 wings. Okay, so you can say there are 2 sort of buildings, Wing A and Wing B. Construction started on 1st April 24 and Wing A was completed by 31st December 2024, while Wing B continued till June 2025. Okay, so there's a difference in terms of the completion date of both the wings. Now, what's the question? When should LMN stop capitalizing borrowing costs for Wing A? Okay, so when should this capitalization be done for Wing A? And up to what date you will do that? So we have got these four options: up to 31st December, up to 30th June, on the date when the loan is repaid, on the date of overall project completion certificate. Over to you. Now, you can just again select your answer, which one you think will be the right answer. A, B, C, or D. Yeah. Which one you think is the right one? A, B, C, or D? Done? True? All right. So let's look at the solution now. I think this is quite simple. Yeah. So what is the right answer? 31st December. We have discussed. So if you remember that example on TAR A, B, C that we discussed. So therein, because each of these wings are independent, so that's why you don't wait for the other wing to get completed. Until that time, keep loading the cost to the cost of the asset. That will be inappropriate. So that's why what should you do? Until this wing A is completed, you will add. Once that is ready, you will stop. Okay, clear? All right, so now moving further. So we'll come back with similar sort of questions for you to practice. Okay, all right, so now let's talk about types of borrowings. See, there are two types of borrowings which are possible. Now, what is the type and what is the context? So let's try to understand each of these with an example. Let's suppose a company has taken a loan. Okay, and the company is constructing a building or plans to construct a building. Now, this loan is taken specifically for construction of the building. So what is the amount of the loan? Let's suppose 50 crore. Okay, specifically for the construction of the building, this loan is. Means this loan will not be utilized for any other purpose, but for construction of the building. So in this case, this entire interest cost, where do you load it? On the building. Why? Because you know where are these cash flows going to be utilized. Correct or not? Yeah. So in this case, because this loan is taken specifically for the construction of an asset, so that's why this is called as a specific borrowing. Okay, it's a specific borrowing. When it comes to a specific borrowing, it is very easy for we to check where do you load this interest. It's required to be loaded on the same asset. Yeah. Now, let's take another situation. So the company has a term loan, 20 crore. Why? This is taken for construction of the building. So the cost of the building is expected to be 50 crore in terms of its construction. So they have a term loan, 20 crore, which is specifically there for the building. Then the company has got some working capital loan, say 10 crore. They have OD, 15 crore, right? And the company is also generating some funds. So some funds are internally generated. Now, what is the meaning of internally generated? Say the company is already running a business. So they are planning for expansion. So that's why they are constructing some, or they are coming up with some more infrastructure. So in this case, because the company is already into the business, they are running the business, they are operational. So let's suppose they have already 2-3 plants which are going on. So the company will also be generating some funds. Sale and purchase is taking place, so profits, all of these things which are there. So the company is also generating its own funds. So it's not only being borrowed or availed from outside. They are also churning it. Yeah. Now in this case, there is a problem. Now what is the problem? See, on this building, 50 crore will be spent. So we can say that this term loan, because this is taken specifically for the building, so this 20 crore goes to the building. Okay, clearly. So this goes to the building. Yeah. What about remaining 30 crores? Where does this fund come from? Can we say this entire working capital loan will be taken? Entire OD will be taken for the building? Or we can say no, the management is generating the funds. Those are being utilized. Yeah. Now, money is not something which you can identify. So can you identify that which of these loans you are utilizing for the building? The answer is no. Okay. So practically it is not possible for the company to do this. So in this case, the complexity arises. Now, what is the complexity? Now, if you were to compute the interest on the building or the amount which is spent on the building, which has to be capitalized. Now, which one you will pick up first of all? Means which out of these loans you will say is now getting utilized for the building? Can we say that? Answer is no. So that means when the loan is not specific, or when other than specific loans are also being utilized for the qualifying asset, in such a case, we need to find out some mechanism. Yes or no? We need to find out some mechanism using which we'll have to compute the interest to be loaded to the cost of that qualifying asset. Correct? Yeah. Otherwise, how will you do this? It's not possible. Yeah. It may become very, very difficult. Correct? Yeah. So now what we will try to do is we'll just try to discuss both of these situations one by one with the help of some examples. We'll try to understand as to what do you do when you have specific borrowings, how do you capitalize it? When you have general borrowings, how do we capitalize it? When you have specific as well as general borrowings, how do we capitalize it? Okay. So let's pick a few examples to discuss all of these situations, right? Now, on 1st June 2024, XYZ took a loan of 1 lakh from a bank at an annual interest rate of 10%. Okay. So the company has taken a loan of 1 lakh from the bank and the rate of interest is what? 10%. Purpose of this loan was what? To finance the construction of a factory. So therefore, which type of loan you will consider it as? It's a specific borrowing. It's a specific borrowing. Yes or no? So every time there is a loan, what do you call it as? You'll have to find out whether it's a specific borrowing or general borrowing. So this appears to be a specific borrowing. Now, in this case, construction was started on 1st July 2024. XYZ temporarily invested 80,000 borrowed money during the months of July and August 2024 at the rate of 2% per annum. So now in this case, what has happened? 1st June 2024, loan is taken. 1st July 2024, construction got started. Okay. And so practically you will not find this. Practically, what will the company do? Company will generally be drawing the money or the funds which they require. See, on day one, entire amount will not be spent on the factory or the building or any asset. Yes or no? It will be required on a regular basis, but it's not something that you'll spend this entire money on day one and it's done. No. So that's why what will the company do? Company will generally draw the money which is required, or as and when it is required, they will keep drawing the money and keep paying the interest on that. But let's suppose the money is fully drawn and some part of that money is now not getting utilized. Why? Because temporarily there will be some period when entire money will not be used. So what can the company do? During such a period, company can park those funds, say in a fixed deposit or in any other investment. Yeah. So the company has done the same thing over here. So they have temporarily invested 80,000 borrowed money during the months of July and August 2024. Okay. On which the company has earned 2% per annum. Correct? Yeah. So this is what the company has done. Now, in this case, now the question arises, what will be the amount of borrowing cost to be capitalized? Okay. And we are looking at the calendar year here. So let's not go by the financial year. I think we are looking at the calendar year. All right. So now, in this case, if you look at the period for which this interest will be considered. So when do you start? 1st July is when you start. Yes or no? Yeah. So on 1 lakh, what is the interest rate? 10%. For how many months you will consider it? 6 months. Because it's a specific borrowing, so that's why this entire interest, where do you load it? You will load it to the cost of the asset. Okay. So what is that amount? It comes out to 5,000. Further, the standard says that if those funds are temporarily parked in an investment and that investment has fetched some return, so what do? You will reduce it from the cost that you capitalize. So that's why on this 80,000, the returns which the company has generated for this 2 months period, what do? You will reduce it from the cost to be capitalized. So that's why, what is the amount of borrowing cost that you will capitalize? 4,733. Okay. So now in this case, every time, what do you need? See, total interest, as we discussed, is very simple to compute. Let's suppose your total amount comes out to X. Okay. Now, in this amount, we understand 4,733 is what you will capitalize. Yeah. So the balance amount, what do? Balance amount goes to P&L. Balance amount goes to P&L. So that's how you need to look at it. Clear? Yeah. All right. So now let's look at one more example. An entity constructs a new building commencing on 1st September 2020, which continues without interruption until after the year end on 31st December 2020. Now, in this case, please ignore, you may be thinking that it's a very small period. So why are we considering such a small period? And what will become the basis of calling it as a qualifying asset? So that's the part you can just ignore, because this is only for the purposes of our discussion. Okay. Directly attributable expenditure on the asset is what? 2 lakh in September and 3,50,000 in each of the months. 3,50,000 in October, 3,50,000 in November, 3,50,000 in December. So this is the expenditure which the company has spent. During the year, entity had 10% debentures in issue with face value of 1 million. So they have one loan having a rate of interest of 10%. Overdraft 5 lakh, which increased to 6,50,000 in December. Interest was paid on this overdraft at 15% until 1st October, after which the rate got increased to 16%. Now, in this case, we have a sort of problem. What is the problem? We do not have the specific borrowings. Correct? So when we say that this amount belongs to a qualifying asset on which funds are getting utilized from these general borrowings, how do we know? Or even if, let's suppose we say that, okay, the funds are being used from the general borrowings. So which general borrowing you will consider? Will you consider all debentures, entire overdraft, or some part of debentures, some part of overdraft, and what is going to be the proportion of that overdraft? What is going to be the proportion of that debenture? Possible? No. Yeah. Practically, it's difficult for the entity, very difficult. Yes or no? So that's why in such a case, what do we need? We need to find out a mechanism using which we'll have to compute the amount of interest in respect of the borrowings which are used for this particular qualifying asset, and derive an interest rate, which is technically called as capitalization rate. Okay, so this rate we will have to derive. Using this rate, what will you do? You will do the capitalization. Okay, so let's try to understand this. Okay, so let's move further on this. Now, what is the first step we'll follow? Calculate the amount which is spent on the project. Now, what is the amount which is spent on the project? 2 lakh in September, 3,50,000 in each of the months. Okay, so if you look at the cumulative amount, that will give you the carrying amount of the asset. So 2 lakh was there in September, right? So this was there in September. Then October, this got increased to October. Sorry, in November, it got increased to 9, means the cost is getting loaded. December, it became 1,250. Now, what is going to be our first step? We will compute the average of this. And the right average will be to compute the average by assigning the weight of time. So that's why, what do you do? Weighted average you will calculate first. Okay, so this comes out to 7,25,000. So weighted average of the amount spent on the project, or in other words, we can say weighted average of the carrying amount of the asset. Clear? Now what is our second step? Let's compute the amount of interest. So we'll compute the total interest. Okay. On 10% debentures, 1 million is the amount. For what period you will consider? September to December. Then overdraft was 5 lakh to begin with at 15%. So overdraft 5 lakh in the month of September at 15% is this interest. And then this interest changed to 16 starting from October, remained up to November. So overdraft amount was 5 lakh. Rate changed to 16% for 2 months. What is the amount? 13,333. Then in December, the overdraft amount increased to 650. So now we'll pick up 6,50,000 at 16% for 1 month. So what do you get? 8,667. So what is the total interest cost or the borrowing cost? 61,584. So total we have computed. See, total is very easy to compute. Always. Correct? Now, what is going to be the next step? Now, in respect of the borrowings that we have, what do? We will calculate their average. And the best average again is what? By assigning the weight of time. Okay. So this 1 million loan, 4 months is the time weight. 5 lakh of OD, 3 months is the time weight. 6,50,000 OD, 1 month is the time weight. Yeah. So what is the weighted average of the borrowings? This comes out to 15,37,500. Okay. Now, in this case, what do? Now we will compute the capitalization rate. So how do you compute it? So the total cost we have 61,584. And we have the weighted average of the borrowings. What is that? 15,37,500. So if you compute it, what does it come out to? 4% for 4 months. So that means effectively 12% per annum. 12% per annum. Correct? Now, this is the capex rate, or you can say the capitalization rate that we will apply. On what? On what amount you will apply? On the amount which has been spent on the project. What is that? 7,25,000. So on 7,25,000, what do? You will apply 12% for 4 months. So therefore, 29,000 is the amount of interest that you will capitalize. Okay. So out of 61,584, what do? This much amount you will capitalize, and the balance amount, where do you take it? That goes to P&L. Okay. So the balance amount goes to P&L straight away. Clear on this? Yeah? Everyone clear? All right. So now let's look at one more example. On 1st July 2019, XYZ were contracted for construction of a hotel for 4.4 million. Land under the building is regarded as a separate asset and is not a part of qualifying asset. Hotel was completed at the end of June 2020. And during the period, following payments were made to the contractor. Means amount spent, this 4.4 million, you can say a breakup of that is given to you. Means in which month, what is the amount spent by the entity for the construction purposes. Okay. Now, XYZ had some borrowings at the year end. So now they have this year from July to June. Okay. So as at 30th June, borrowings are given. 10% 4-year note with simple interest payable annually, which relates specifically to the project. So what does it mean? It's a specific borrowing. It's a specific borrowing. So wherever we'll have specific borrowing, so that becomes easier for us. Correct? Debt outstanding at the year end is 1.4 million. interest of 1,30,000 was incurred on these borrowings during the year, and interest income was also earned on these funds while they were held in anticipation of payments. Fine. So this is first. Second, 12.5% 10-year note with simple interest payable annually. Debt outstanding at the beginning of the year amounted to 20 lakhs. At the end of the year, balance is same. Okay. So this is second loan. So this is the first one. This is second one. This is third one. What is the third one? 10% 10-year note with simple interest payable annually. Debt outstanding at 1st July 2019 amounted to 30 lakhs. So again, the opening balance is given to us. Closing balance is same. Okay. So now in this example, what do we have? We have a specific borrowing as well as general borrowings. So now the question is same. What is the amount of borrowing cost that you will capitalize? Right? Clear? Okay, so let's look at this. First of all, what do? We'll have to find out what is the amount of general borrowings which has been utilized. So 400 was spent on 1st July 19. And we have a loan of 1400 which is specific borrowing. So this will go out from specific borrowing always. So will there be any amount which will be spent from general borrowing? No, zero. Right? So now out of 1400, 400 is spent. So what is left? 1000. We are taking the figures in thousands. Okay. Next. 30th September, 1200 is the fund required. So for 1200, 1000 will go from specific borrowing. This was entirely from specific borrowing. So what are we left with? 200. So for this 200, where do you go? General borrowings. Means these two. Now we don't know which one of these two. Okay. Then on 31st March, 30th June, 2400 and 400 are required. So these will obviously be going from general borrowings. Yes or no? Yeah. Very clearly, they will go from general borrowings. Now, first of all, what do? We will compute the weighted average of this. So this weighted average is computed over here. Right? Now, next step, we need to compute the weighted average borrowing cost. What is that? 12.5% is the rate on 20 lakhs. 10% is the rate on 30 lakhs. Okay, so that means interest we have computed on both the loans. 12.5% multiply 20 lakhs, 10% multiply 30 lakhs. So we get the total interest. Total interest divided by this entire borrowing. Okay, so what do you get? You get the average interest rate, 11%. Right? Now, let's look at the amount of interest that we capitalize. See, any interest that is there on the specific borrowing that will be capitalized for sure. Do we need to compute it? It's given in the question, 1,30,000. So this you will capitalize. Now, as regards general borrowing, what is the amount which is spent? So if you compute this, this amount comes out to 750. Okay, so if you compute this, this will come out to 750. On 7,50,000, what is the capitalization rate that we computed? 11%. So if you apply that, what do you get? 82,500. So 82,500 is the amount of interest which is in respect of general borrowings. Okay, that is in respect of general borrowings. So that you will capitalize. What is the total interest that you capitalize? 2,12,500. But there's one more point. During the year, 40,000 interest income has also been earned from temporary parking of funds. So what do? You will reduce it from the cost of the project. So that's why, what is the amount that you capitalized? 1,72,500. Clear? Clear on this? Yeah. So this principle of general borrowing is very important. Yeah. So now what we will do is we will pick up few MCQs again, okay, in a similar manner, the way we did it earlier. And now I think we'll have these MCQs on this on this principle that we just discussed on specific borrowing, general borrowing. Okay. So let's look at this third one. ABC began constructing a manufacturing facility on 1st July 2024. Expenditure on the project was 1st July 24, 4 crore. 1st October 24, 2 crore. 1st January 25, 2 crore. So all in all, what is the amount? 8 crore. 8 crore is the total amount. Construction was completed on 30th June 25. Company had following borrowings during the year. There is a specific loan, 3 crore. So that means for this amount of 8, 3 will be utilized from specific borrowing. Clear? Now, what about the balance amount? What about remaining 5? Where does it come from? So this 5 crore comes from general borrowing. 5 crore comes from general borrowing, which is at what rate? Which is at 12% per annum. Now, in this case, question is, what is the amount of borrowing cost that you will capitalize? Yeah. So we got 4 options. 54 lakhs, 60 lakhs, 72 lakhs, 84 lakhs. What do you think is the right option? Over to you. Yes, you can just choose the right option. Then we'll look at the answer. Okay. What do you think is the right option? A, B, C, or D? Done? All right. So now let's look at the solution. See, in this case, right option is C. Let's understand why. On the specific loan, what do? 3 crore. 10% is the interest. So this 30 lakh you will fully capitalize. Simple, straightforward. Remaining expenditure will be financed by general borrowings. Okay. So what is the total qualifying expenditure? 8 crore. 3 crore goes from specific borrowing. Remaining 5 crore, as we discussed, will be spent from general borrowings. So therefore, what do you need? You need that weighted average expenditure. So this 5 crore that you will have, for how many months you will consider it? You will consider it for 9 months because it starts from July. Correct? For 9 months you will consider. So weighted average expenditure comes out to 3.75 crore. Okay. On this 3.75, what is the rate you will apply? 12%. So the good thing is in the question, we do not have 2-3 general borrowings. Only one is there. So 45 lakhs. So 30 lakhs is one. 45 lakhs is the second one that you have on general. So this is on specific borrowing. This is on general borrowing. So all in all, what do you have? We have this 72 lakhs. Okay. Right? Clear on this? So I think this may be a typo, maybe 75. Okay. So that's the number you'll have. Right? So let's move on to the next one. JK Limited incurred the following expenditure for a qualifying asset. 1st July 24, 5 crore. 1st October 24, 3 crore. Okay. Company used general borrowings. 10 crore at the rate 10% from 1st April 24, 10 crore at the rate 8% from 1st January 25. Okay, so they have got two general works, or you can say one at different rates. Either way you can consider it. Construction continued throughout the year. Now you are required to compute the borrowing cost to be capitalized in the given situation. Yes, over to you. Quickly, what do you think will be the right option? So I'll just try to put it in a single screen. So we got four options: 60 lakhs, A, B is 68 lakhs, C is 72 lakhs, D is 75 lakhs. So which one do you think is the right option? You can just submit your response. Then we'll look at the solution. Over to you. Yeah. Done? All right. So now let's look at the solution. Now in this case, if you look at the weighted average rate till December, what does it come out to? It comes out to 10%. That's given. From January to March, this weighted average rate comes out to 9%. So average accumulated on the basis of weights that you assign. Okay. So 5 crore you will consider for 9 months, 3 crore you will consider for 6 months. Okay. So what is the amount that you have in terms of weighted average accumulated expenditure? 5.25. Yeah. On which you will apply the capitalization rate. So therefore, what is the right answer? C, 68 lakhs. Clear? So towards the end, we'll try to find out as to what is your response. Okay. So now moving on to the next part. So if you go back to the borrowing cost, which we discussed, we talked about one component, Forex. And we discussed that this foreign exchange loss may also be considered as interest. Okay. Now, I think this concept of Forex to be considered as borrowing cost can be best understood with the help of an example only. Yeah, so that's why what we will do is, I'll just take you to an example, and with the help of that example, we'll just try to understand this concept also. Okay, so let's look at this. ABC has taken a loan of 10,000 USD on 1st April 2020. It's a foreign currency loan which the company has taken for a specific project at an interest rate of 5% payable annually. Yeah, so what is the actual rate of interest? 5%. What is the loan amount? 10,000 USD. Please remember this loan is in USD, foreign currency for the company. It's not in the functional currency. Corresponding amount could have been borrowed by the company in local currency, but in such a case, interest rate would have been 11% per annum. If let's suppose company would have taken this loan in India in INR, so the rate would have gone up. This would have become 11%. But that's a notional thing. That is not the actual rate. Yeah. What is the actual rate? 5%. Now, where do we need this 11%? We'll talk about it. Okay. On 1st April 20, exchange rate between the currency was, so exchange rate USD INR is given to you 66. At the year end, 31st March, exchange rate is also given 71. So it has changed from 66 to 71. Now, in this case, we are required to calculate amount to be capitalized with the value of the asset with regard to the loan which is taken in foreign currency. Okay, so let's look at this. Now, in this case, what do? It's a foreign currency loan, correct? So when you have a foreign currency denominated monetary liability, if we apply the requirements of Ind AS 21, okay, I'm not talking about the standard. What does it say? any foreign currency denominated monetary liability, if that is outstanding at the year end, you need to restate. So initially, what is the rate at which you would have recorded this loan? 66. At the year end, what do you need to do? You need to update this to 71. So if the value of liability goes up, so there will be a loss. There will be a loss. What do you call this loss as? Forex loss. So there's a Forex loss of 50,000. If the company has taken loan in foreign currency, it has incurred a foreign Forex loss of 50,000. Okay. Now, what is the rate of interest? 5%. So what is the actual interest for the company? For the company, actual interest is what? 10,000 multiply with 5%, 71. So this is the actual interest amount. This is the actual interest amount. Now, standard says because the company has taken the loan in foreign currency, so that's why it has incurred this Forex loss. If the company would have availed the loan in Indian currency, this Forex loss would not have been there. So let's try to understand what could have been the interest if the loan was taken in INR. If the loan was taken in INR, so 10,000 at what rate? 66 at the beginning of the year you will apply, on which 11% you will compute. So the company would have paid interest of 72,600. Okay, this would have been paid. This is not the actual interest. This would have been paid. Okay, so now what is the difference between actual interest and this notional interest? 72,600 minus 35,000, 37,100. So company has saved interest amounting to 37,100. Okay. So the standard says that this saving in interest is done. Why? Because the loan is taken in foreign currency, because of which this Forex has been incurred. Forex loss. So that's why to the extent this savings is there, okay, we can adjust this Forex by calling it as interest. Or you can say this saving in interest can be considered to be the part of the interest which is currently being shown as Forex. Or you can say this Forex to the extent of the interest that is saved up to the maximum amount of Forex only can be considered as interest. So that's why what will happen? You will have this actual interest. What is that? 35,500. So actual will remain actual. That will not change. This saving that you had, this can also be considered as interest out of Forex. So now what do? Out of this Forex of 50,000, this 37,100 you will consider as interest, which you can capitalize. And the balance amount out of this 50,000, what do you do with that? That will continue to be treated as Forex, which will go to P&L. So therefore, out of this 50,000, what can the entity do? They will capitalize this 37,100. Okay, they will capitalize 37,100, and the balance amount will not be treated as interest. That will go to P&L. Clear on this? Clear on this? Yeah. So this is how this Forex can also be considered as interest and thereby capitalized. Clear? Now let's look at the disclosure requirements. See, when it comes to the disclosure requirements, this standard talks about the accounting policy in respect of the borrowing cost. Okay, if let's suppose there's a qualifying asset, so what is the mechanism which the company has considered? If at all the company has got the general borrowings, specific borrowings, Yeah, so all sort of disclosures are required to be captured. Correct. Now, if you were to compare the standard with Indian GAAP, okay, both the standards are aligned. So the only difference that you find is what? This concept of EIR. See, under Indian GAAP, you do not have this effective interest rate. You go by the contractual interest rate. But over here, what do you have? This effective interest rate. Okay. So now, what we will do is, now I'll pick up one more MCQ. Okay, so now what we can do is, let's pick up one more MCQ. Okay, so let's look at this one. PQR Limited borrowed 2 million at the rate 6% per annum to construct a power plant. Now, in this case, this money is borrowed in foreign currency, right? Exchange rate on 1st April 24 was 80, 31st March 25 was 85, right? Which of the following statements is true regarding treatment of exchange differences? Okay, so now in this case, what do you need? You just simply need to, don't actually need to get into the working. You just simply need to explain. Okay, so simple one, easy one for you. Entire exchange difference of rupees 10 lakhs must be capitalized. So that is option number 1. Entire exchange difference of 10 lakh should be expensed off. So that is going to be the exchange difference. Exchange difference can be capitalized only to the extent it's an adjustment to the interest cost, the one that we looked at in our example, or none of these options is appropriate. So which one do you think is the most appropriate one? Over to you. A, B, C, or D? I would say it's quite simple. Yeah. Which one do you think is most appropriate? A, B, C, or D? You can select this, right? Okay. So now let's look at the right option. What is that? C. Ind AS allows exchange differences to be treated as borrowing cost only if they are regarded as adjustment to interest cost, not the entire forex fluctuation. Okay, clear on this? Yeah. All right, so I think with this we are through, but we are not through. Why? Because got some questions. So that is again very important. So let's move on to your questions now. Just a minute. All right, so
Do I need to read, Achal, for you?
yeah.
Okay. So first question is regarding the intercompany loan. For example, there is one holding company and there is a subsidiary company, and holding company has provided interest-free loan to the subsidiary company, which in turn subsidiary company has utilized for the purpose of constructing a qualifying asset. Now this is the interest-free loan. So this loan is required to be treated as per Ind AS 109 by applying the EIR method. So whether this interest can be capitalized or not to the cost of building which is under construction.
See, as he just mentioned that so it's the subsidiary company which has taken the loan.
Right. So subsidiary company has taken interest-free loan, let's assume for 10 crore rupees from the holding company. And in turn, this subsidiary company has utilized this fund in order to construct the building, let's assume. So building is a qualifying asset. So the query is that whether the interest, which will be calculated as per EIR method, because as per Ind AS 109, if you have taken a loan from your holding company, which is interest-free loan, right? But as per Ind AS 109, this loan is required to be treated as per fair value. So we are required to do the EIR accounting. So whether that interest, which is the notional kind of interest, can be capitalized to the cost of building which is under construction or not.
Correct. So see, if you look at the requirements of the standard, so it's not only limited to Ind AS 23, but this financial instruments also come into the picture. See, for the purposes of our accounting request, we'll have the same accounting treatment, and that is what we discussed. So in fact, if you pick up this borrowing cost when we started with, So therein we discuss that any interest of any sort will have to be treated the way this standard requires. Okay. So it doesn't matter whether it's notional or actual. Yeah, something which we assume to be notional is not notional. So that is what the standard requires. It says you go to the substance. Actually, we go by the legal form. So that's why we say that it's actually not an interest. But if you look at the requirements of the standard, standards considers that this is the right way of doing the accounting. So that's why
Correct.
if it's an interest, you need to capitalize it, provided it's qualifying. Otherwise, we'll charge it off.
Absolutely correct. Okay, second query is that can borrowing cost incurred before obtaining actual loan, for example, pre-construction expenses, be capitalized later? Means activity has been started first and loan has been taken later on.
No, so if let's suppose loan is taken later on, okay, so there's no interest. So what is going to be capitalized then?
Correct.
So the interest will come when the loan will come. Prior to that, why will you pay the interest? So seems there's some confusion now. Anyways, yeah.
Okay. Third query is that how should companies handle situations where only a portion of project is delayed? Do they suspend capitalization partially?
Again, you'll have to look at as to why do you say this project is delayed on a proportionate basis. So this proportion will have to be understood in detail. So if you can just maybe sort of relate this delay of the project on a proportionate basis, then of course you'll do this suspension adjustment on a proportionate basis. But I find it difficult to relate to if let's suppose you are saying there are three towers. So one tower you are saying is delayed by 2 months, second tower you are saying is delayed by 1 month. So that is how you can always allocate. Otherwise, I find it difficult.
Okay. Number 4 query is that if an entity purchases a ready-built structure to house workers for a plant which is under construction. So I am reiterating, if an entity purchases a ready-built structure to house workers for a plant which is under construction, can interest on that loan be capitalized?
See, again, the point is for us to understand will be that what is the asset or what is the underlying asset which is getting constructed, or do we have any qualifying asset or not? So the moment you say that there is some construction going on, so I'm assuming that to be a qualifying asset. If that is a qualifying asset, of course, any loan that you will take on the qualifying assets, you will capitalize. But if let's suppose you say it's not a qualifying asset, you will not capitalize. So the question for you will be whether it's a qualifying asset or not. So that's how you'll have to look at it.
Okay. Next is, how should entities treat borrowing cost if the asset is ready for use but pending safety or occupancy approvals?
See, there again, I think it's a practical point actually, wherein we need to evaluate about the usage. To say that the asset is ready for use is not something in terms of the structure you'll look at. Yeah, so you'll look at in respect of each and everything. So whether you can actually go and use the asset or not. So if you believe there are some relevant approvals without which you can't really use the asset, for example, building, you have not received the NOC, you have not received the requisite approvals, and which is more of an administrative process, okay, which will take some time. So of course, you'll wait for that to be completed. But there again, you'll have to understand the abnormal delays should not come in. It should not happen that maybe 2-3 years are going on and during that period you keep capitalizing it. So there again, you need to differentiate.
So we are concluding that if the approval is pending with respect to safety or occupancy, then building is still under construction.
Yes.
Or the plant is still under construction.
Yes.
Okay. Next query is that in situations where a company temporarily deposits surplus funds from specific project borrowings into its cash credit account to reduce the overdraft balance, and such deposits results in saving of interest rather than generating any investment income, should the company deduct the interest saving from the borrowing cost eligible for capitalization under Ind AS 23?
See, I would put it in a very different manner. Why? Because when you are saying it's a specific borrowing, so the first point is, are you really allowed to do this? Which you have just specified, that can you really apply the fund for that purpose? It appears to be very difficult for me that a company can do that. And that's how I think one will have to look at it. Because if the company is doing something which they are not allowed to do, then of course we are not looking at the right accounting requirements. Okay. Otherwise, we will be looking at some notional sort of income which is not appropriate. Okay.
Correct. And one point which I wanted to highlight here is that this question is also available in the education material on India's 23. So for the benefit of everyone, I'm telling, if you want to look at the facts and the answer, so this query is available in education material.
Great.
Okay, I
That will
have
be
one
helpful, huh?
query. Yes.
Yeah, sure.
I have one query. So suppose there is a company which has issued compulsory redeemable preference shares, right? And let's assume there is a rate of interest of 10%, or you can say the rate of dividend of 10%, which is required to be paid by the company on mandatory basis, right? And the funds have been utilized by the company for the purpose of construction a building, right? Which is a qualifying asset. Now, whether this dividend can be capitalized as a cost of borrowing to the cost of building or not.
Yes, so I think this point again is what we covered, that first of all we'll have to understand the underlying instrument. So this instrument clearly appears to be a debt. Okay, and
Right.
if you go by the arrangement, the moment you call it as a debt, so any return that you pay on that, it doesn't really matter whether it's dividend or by whatever nomenclature you call this return as, that will tantamount to interest, which is nothing but a borrowing cost for our purposes. And the moment you say it's a borrowing cost, you'll have to treat it the way we discussed.
Absolutely correct. So this is it. And thank you so much for such an insightful and engaging session. And once again, thank you everyone for joining us today. We truly appreciate your time and participation. Over to you, Rahul.
Sure. Thanks so much, Paras, for your time today and for again sharing some of these things. And thanks so much, Rahul. And thanks everyone for your time today.